in having a focus on certain what I'll call pockets, there's a lot of good that comes from that as well, with the cost efficiencies and with management efficiencies and things like that. So I'll touch upon that a little bit more in a little bit. We are utilizing local experts as well. So we're vertically integrated, and I'm going to show you a kind of an org chart to give you an idea of what a commercial approach kind of team for single family looks like. But you also want to be utilizing local experts. So Gilmer, who runs the construction in Baltimore for us, he's been in the Baltimore, DC market for going on 30 years now. And the guys in his crew, they're living in Baltimore. They know that market very well. We're also in different parts of our team beyond the construction side. Our property manager in Baltimore is a local guy. Agents that we're working with from a leasing perspective, subcontractors, all that kind of stuff. So we are using local expertise as well. And the vertical integration, what that means. So vertically integrated owner operators. One thing sometimes with ways or certain funds are structured and things like that, a lot of times people will think, are we lending money out? We don't do any lending. We're not a hard money fund or private money lenders or anything like that. So we are the owner operator, and vertically integrated. Essentially what that means is we have a construction company in-house and a property management company in-house, and we manage everything, soup to nuts, from a construction standpoint and a property management standpoint. And I think that's really important in single family, especially in the essential housing market, in workforce, affordable housing, middle income, attainable housing, that kind of thing. Being able to control that process and the timelines, the budgets, the guys on the crews, the workers, things like that, I think is a very key is a key to success in the space. A lot of times where I see people go wrong is trying to use outside work. They're going to pay a lot more, and they're going to lose control over time frames and budgets and things like that. So that's a big part of I think taking a commercial approach and finding success in this area, is having control over the construction and the property management. So this is our org chart. The reason I wanted to show this was because it gives you an idea of, we're looking at this from a business perspective and not just a portfolio. So my partner, Ron, who's with me today, he sits at the top as the managing partner. Then it's myself and my partner, Wade. Wade's really running the finance and the accounting side of the business. We also have a mortgage investment side of our business that we run. That Wade really sits at the helm of that and runs that side of the business. His wife, Tracy's our controller. We have an amazing bookkeeper, Holly. And then we work with, outside accounting and things like that. We have John, who's kind of the head of the property management side, Brian, who's the head of construction. And then you see how it trickles down to who's managing Baltimore, who's managing Philadelphia and South Jersey, and then the crews and subcontractors. So, not to speak too much about us, I want to keep this educational, but I just wanted to give you an idea of the team and the structure and the organizational structure that it takes to really, to what I'm calling bringing a commercial approach to the single family space, and not just running this like a mom and pop portfolio or somebody that's going to want to buy a few properties. One of the questions I get a lot from investors is when does the portfolio get too big? And we're looking at this in the exact opposite way. In scale is those efficiencies. This is when it starts to look a little bit more like multifamily, but you're having the benefits of the financing, the residential financing, plus this sheer supply and the demand in the markets that we're in, and we'll speak to that in a few minutes. So what do we do, and who do we buy from, that kind of thing? So I showed you some pictures of properties before. Who's selling properties that look like that? Tire landlords. So, we do a lot with landlords who've been in the business for a long time. Actually, sometimes they could be in the business for a few days, a few weeks, man, they're just tired. It's just not the business for them. They don't want to do it. I feel if anybody's ever been to a real estate networking meeting, you could probably envision somebody who fits that bill pretty well. So we deal with people like that. That's why I separated retired landlords, because retired landlords, they're people that they might love what they do, but they're just at a different aspect of their life now, different phase of their life. You know, they got grandkids, maybe they got a house, you know, down the shore in the mountains or something like that. You know what I mean? And it's not, they haven't ran the properties into the ground or anything like that. You know what I mean? Like it's, they didn't start a job and then they didn't finish it, or, you know, so ran out of money or something like that. These are people that have probably take pride in what they do in a lot of ways. And some of them have great relationships with their tenants and things like that, and they're just retired now. You know what I mean? And sometimes you're buying, you know, we'll talk about the different types of properties, but you know, just to give you an idea, there's a difference between tired and retired landlords. Out of state owners we deal with, especially in the Baltimore market, you know, speculators, people who are buying property, you know, thinking prices are going to go up, they sit and hold. You know, you get that anywhere in Philly and New Jersey as well. So we deal with out of state owners, estates, you know, so times when somebody's passed away, and you're dealing with the family or kids, that kind of thing. We deal with passive investors, bad investors, active investors, you name it, you know, so it's all kinds of different people who sell these kinds of properties. And like I was showing before, you know, there's properties that we're going to buy that are fully dilapidated, you know, something where we're taking it down to the studs, or really the brick wall, and then just redeveloping, rebuilding, and handing over almost new construction. And I'll speak a little bit more to that in a second. We'll buy individual properties, we'll buy portfolios, and we develop as well. So we're always looking for lots and land that we can develop new homes or small apartments on. And where do we buy? We do a lot of off-market deals. We'll do on-market deals. Baltimore has a very active auction scene, so we have some great relationships with auction sites in Baltimore where we'll buy product. Coming back to like what I was talking about with pockets, direct to owner is something we'll do as well. If there's certain areas that we've defined that we really like, you know, we're finding typically phone numbers, ideally, you know, but maybe an address, that kind of thing, sending a letter. But phone numbers are great, you know, just making calls directly. You know, when you own a property in a certain area, or you like a certain area and you're driving around and you know that area well, you know, you see obviously the properties that you want will stand out to you if you know what you're looking for. So we'll do that. And then government sponsored entities. So my partner Wade has a lot of those relationships, and the note side of our business, nearly 100% of that product comes from government sponsored entities. On the real property side, that product kind of ebbs and flows. So sometimes we'll see more product in those types of in that avenue of acquisitions, and sometimes we don't. So it's kind of having a lot of tools in the tool belt, I think, is very important when you're talking acquisitions. So just kind of paint another picture. You know, I showed you some inside pictures of properties. This is the outside, you know, so we deal with a lot of times what we're investing in is urban areas, metropolitan areas. So row homes, you know, attached homes is a lot of what we do. It's not everything, you know, we certainly do standalone, detached homes as well. But just wanted to, you know, trying to put an image in your mind of what we do and what it looks like and the properties that we buy. So just a couple pictures of properties that we own. All of the properties that you see in this presentation are all properties that we own, including this one. So to give you an idea, like I said, you know, dilapidated single family homes, our buy boxes is we want to purchase properties and renovate them, ideally under $130,000. Or less is great as well. We will go over that occasionally, but the ARV really needs to support it. So if we're 130 or less, our ARV, ideally it's 185, or at least it's 185,000. Ideally, it's closer to 200,000. You know, typically, you know, we're dealing with properties that are valued under $250,000. And one of the reasons we do that is that's where, from a development standpoint, as a country as a whole, you know, less than 3% of new homes being developed are valued under $250,000. So these homes are a rare commodity. You know, it's just, we're not creating new homes that are valued under $250,000. So just massive demand in that sense for homes under $250,000. It also provides great diversification. You know, we certainly invest in the suburbs and other areas as well, but a lot of times finding deals where we can be all into it from a purchase and renovation standpoint at 130,000 or less is difficult. And it's not that we couldn't create the equity we wanted to, but then maybe we have, 200 or $260,000 into one deal or $300,000 into one deal, when in this case we could have it diversified over two deals or three deals. So we like that from a risk perspective. We'd rather have it, spread around a couple different properties instead of putting all of our eggs in one basket. So if we're all in for 130,000 purchase and renovation, we have an ARV of on the low end of 185, ideally closer to 200 or even more than that. We're going to do a refinance at typically 70% loan to value. Interest rates right now probably about six and a quarter, 6.35, something like that. Our last one I think was at 6.35. We actually work closely with DLP there, Daniel. We're on their elite members or something like that. Ron knows that a little better than I. So we get great pricing through them, and we've done a lot of business with them over the years. So what we'll see on a rent, I put 1650 there. Actually, I think the last batch of properties we've been renting are all closer to 1700. But like I said, will take properties on where maybe it's an undervalued lease. And I mean, so leases sometimes could be between 900 to, maybe 12, 13, 1400, but market rent for everything we buy is typically closer to 16 to 1700. And the taxes and insurance, you're usually looking at about $2,600, 2,600 annually. So that's one of the things we love about the markets we're in. The taxes and insurance are very, very low, very reasonable. So that this is kind of our buy box at the end of the day. And to break it down even further, we want to be all into a property for 60 to 70% of the market value. So we're creating 30 to 40% equity in every deal that we do. At a 70% loan to value refi, that's where the holding cost comes into play, and why the markets we're investing in is great. We're getting almost all of our cash, sometimes all of our cash out of a deal in a refi. So at that stage of the game, we have no basis in the property at that point, and it's just all cash flow from there. So it's kind of an infinite return, right? So that's one of the best scenarios. Doesn't always happen. Sometimes you leave a little bit in the deal, but ideally it's a minimal amount that we're leaving in, and then. Like I said before, it's a BRRRR method. So we're buying, we're renovating, we're renting it, refining it, and repeat. It's not that we don't sell properties either. It's just for the most part, we're buy and hold investors. There's always going to be opportunities to sell. It's nice from a cash flow management perspective. So we do sell occasionally. But every property we buy, we look at it as, can we hold this property long term, and could we also sell it? I think that's another very important aspect of what we're doing and the markets that we're investing in, and I think that might be covered on the next slide. So the 30 to 40% equity we want to create in each deal. From a cash flow perspective, we like to see at least $300 a door. And that's after all expenses. That's net income. So kind of give you an idea of the due diligence, the underwriting, the analysis. Like just so I was kind of explaining the buy box that I was just defining. We try to take a very systematic approach of what we do. We just want to rinse and repeat. I mean, so pretty much just do the same deal over and over again, day after day. That's going to help when it comes to that commercial approach that I was talking about before. If we could just kind of find very similar deals that fit within our buy box and just rinse and repeat over and over again, it's great from a management perspective, and the guys, our guys on the crews know what we're doing because we do it every single day, and every property we buy, it's pretty cookie cutter, that kind of thing. So we follow a very defined set of rules to achieve a desired outcome. I just went over this before with 60 to 70% of the fair market value. In order to do that, you have to know the comps very well, and you have to know your renovation cost. And I think that's another crucial part of the vertical integration, knowing what our cost is going to be from a labor and materials perspective. And then you have the market dynamics. That's something we're looking at from a macro and a micro version. One of the reasons we're in the single family space right now, and not so much in the multifamily space. We occasionally do buy small multifamily, but from a market dynamics perspective, it's just the demand is a lot higher in the markets that we're in for single family product. It's when you poll the average tenant, um, who wants to live in a single family home versus a an apartment building, apartment unit, 80% of people will say they'd rather live in a single family home. A lot of times too, in the types of people that we're dealing with, they're families and they have children, or they're older, they're looking for more space, they're looking for more privacy. The other thing too is we don't see as much institutional and larger competition in the space when it comes to the single family world. We're investing in the built environment, so we're investing in urban and metropolitan areas. So we're not typically competing, like down south in these other areas where there's huge tracts of land they're developing and adding, hundreds, if not thousands of units to market. So on the single family side, it's a redevelopment play. Not that we said before, we do go after lots and we do development in that sense. And I think some of the future slides I'll discuss a little bit of that more.
Hey,
But
Peter,
Mhm.
do you mind if I jump in with a few
Yeah,
questions?
no, please do. I'll just talk
Sure.
all
And,
day.
and
Please
first
do.
of all, good use of Monty Python quotes there with huge tracts of land. Um,
Didn't even do
but
that purposely. It's funny.
the first question we have here is from Glenn, and he's asking, do you work with government agencies like HUD or GSA, and how does that change what you do?
Yeah. Ron, did you want to?
Sure.
Okay.
So and thank you, first of all, thank you all for having us today. It's nice to be here and speaking with you. So how the genesis for us when it came to this particular market, as far as housing is concerned, came through working with government services entities. My company prior to this was a certified development services partner for the NSI program through the National Community Stabilization Trust. So a lot of the assets that we're getting through that program, we were portfolioing some of them, we were renovating and selling them. And as we started taking, and that was probably around 2016 going into 17, as we started taking a closer look at the properties we were working on, we thought, the demand for these is just through the roof. And so we started really portfolioing just about all the properties. We sold very few after that. So we have worked, Wade, our other partner who Peter mentioned, I worked with Wade before we formed GSPREI. That's actually how I met him through one of the government service entity programs. So to answer the question, yes, we do work with them. And to Peter's point earlier, as far as programs like the NSI and the NSO, which is more on the note side of the business, that really has ebbed and flowed over the years. And the quality of the properties coming out of there from a price standpoint hasn't been as attractive. But we certainly still watch that. We still utilize other programs through HUD to access properties more on the note side of the business these days. But they also go towards our portfolio as well.
Okay. And next, actually, if you don't have to, but a few slides back, there was a picture of a nice red house. And there it is. And Prolette is asking, nice, she says, nice red color. Do you have somebody responsible for the design you do across your homes?
So we do, and that's within our construction management team. And a lot of that has to do with buying power. Now, not so much on the paint colors we select. We try and pick colors that are unique for us in certain areas and stand out. But we have national level pricing on many materials. And one thing I want to point out, Peter talks about our in-house construction. The scale of our operation isn't just relegated to our own work. We do hundreds of projects a year for other people, investors, because as we invest, we're certainly restricted by the amount of capital we have raised. So we always, and if you see the bios on here, I cut my teeth back in 25 plus years ago on the construction side of the business. And that's really how I got into real estate. So it's always something that we have utilized for me in particular over 25 plus years is construction. So it's certainly one of our strengths. So we not only are doing work for ourselves, we do work for other investors, other entities, and that's where our buying power comes into play. So we communicate with them the type of product we use. So we have, to Peter's point, we're very cookie cutter with what we do, but it's strategic.
Okay. And then the last question for the moment is also from Glenn. He's asking, what percentage of your houses are in Baltimore, and is your buy box different for other MSAs? Took a little liberty with your words there, Glenn.
Yeah. So what percentage? I would say probably right now about 40% of our houses are in Baltimore. We like Philadelphia and the surrounding areas, not just Philadelphia. Southern New Jersey was historically a big market for us, but that's become, it's obviously a competitive market. It's a very competitive market, but property taxes play a huge role in New Jersey when you're selecting a specific market within. Our buy box definitely will expand a little bit from a price standpoint if we're moving into one of those other markets, because what we're able to do in Baltimore, I like to say, is where Philadelphia was 12 plus years ago. And that market's moved a little bit. So we're not necessarily getting into Baltimore for the same prices. We're still creating the same margin and the same equity from a percentage standpoint. And we would do the same thing in New Jersey, but it definitely expands a little bit. We've had a big focus on Baltimore over the last 3 or 4 years, just because we see a lot of opportunity. We invest a lot around hospitals. And we've been fortunate to through our due diligence and our research to pick the right areas, and we're experiencing a lot of success there. We're doing some new development projects down there, new construction townhouses. So doesn't mean we've given up on other markets. We're always looking for markets beyond the markets that we're in, but we are always focused on deploying the capital we have in the best way possible to create the most value.
Absolutely. And it's great to buy up old houses that are dilapidated or in need of some TLC and just bring them back up and put a good person in it. It's a public service.
Yeah, and we really, we get asked a lot of the time, what's the competition like in markets like Baltimore for something like this? If there's competition when somebody is trying to do kind of what I like to call a lipstick job, where they're just throwing a little bit of paint on there and putting it back on the market. Where we excel is we look for the properties that are fully dilapidated, that we're taking down to the 4 brick walls, and we're effectively building a new house within those 4 brick walls. So it's all new framing, it's all new plumbing, it's all new electric. It's basically a new house. And when you move into that market, there's not as much competition. And Peter mentioned earlier, we get a lot of our product through auctions and auction houses in Baltimore, and they've come to know us pretty well. We have a great working relationship with one of the owners of one of the biggest auction houses in Maryland, and they bring us product before it even goes to their auction sites. And we'll present them offers to keep it off the site, and hopefully we get them. We also work with the city through their vacant values program, which they have 14,000 homes that are sitting vacant. A lot of bureaucratic red tape, so that's not always the fastest process, but it's another good resource.
Okay. And then Glenn had a qualification, or a clarification rather, on his question. And I think you've answered some of it by mentioning some of the programs that you buy through. But he's asking what percentage of houses are available at a 130K price. I assume those are all dilapidated homes at that value, and they're all coming through a program or auction. But is that the case?
Yeah, those primarily come through the auction houses, and we're buying those properties for $20,000.
Yeah.
And then we're fully renovating them.
Okay. All right. There's a few more questions that are coming in. I'm going to hold them and let you guys go on with your talk for a little bit.
Yeah, these were all really awesome points and a lot of things that we'll touch upon, so we can run through this very quickly. One thing Ron had mentioned was hospitals. I always like to mention that. That's kind of giving away some secret sauce there when we talked earlier about pockets. What kind of defines those pockets? Well, schools is obviously something you're always going to look at, but hospitals is a big driver for us, and it's one of those things where we didn't set out to do it. It was something that we found out over time and just analyzing the portfolio. So hospitals, the good ones, will do a lot of community investments. So they'll own property, they'll invest in land and in businesses and in funds and things like that within the community to make their surrounding area that they're in better. So that's a big driver that we look for is hospitals that are doing a lot of community investment. Access to transportation is always a big one, especially in Baltimore, where DC is providing a lot of jobs. There's a lot of jobs in Baltimore, which we'll talk about in a second, but the access to transportation is good as well. You don't want to be too close, you don't want to be on the corner with the bus stop, but you do want to be in walking distance. You do want to have access to transportation. And then obviously crime trends. I mean, I hear it all the time. Do we invest in war zones? No, we do not. We definitely do not. And I think one of the big ways you look at kind of separating war zones from war zones is one thing I mentioned before is when we buy, we look at, is this something we can hold long term, or is this something that we can fix up and sell as well? And a lot of times in areas, that are kind of quote unquote war zones, you tend to only see investors buying in those markets. You don't see too many regular people buying homes in those markets. It's very important to us that we see homes trading by regular homeowners. So that's another thing that we look for in the markets that we're investing in. So obviously schools are a big one there, and then just crime maps. And I mean, looking at crime maps for the areas we're investing in and seeing if they're trending in the right direction, very important. So we talked about this. This is kind of a visual representation of our portfolio. You can see a healthy concentration in the Baltimore market, a healthy concentration in Philadelphia, and then we have properties throughout New Jersey, South New Jersey as well. So Baltimore, why would we be investing in Baltimore? It's a great job market in Baltimore. To give you an idea, you could see some of the major employers in the city: Under Armour, T. Rowe Price, McCormick's is a big one, Amazon's big, John Hopkins obviously is a very big one as well. So a lot of the jobs in Baltimore, it's the workforce, it's bread and butter industries. Over 30% is education, health services. This a circle in the left corner of the screen there just shows different types of employment broken up by percentage. So it's for the type of product that we're providing. The vast majority of the city that's what they're looking for. You know what I mean? Because they're working bread and butter industries: education, health services, hospitality and leisure, government, transportation, and then you have professional and business services, about 14%. So speaking of 14%, if you look at the housing market year over year, they're up 14% compared to the U.S. as a whole of 13. I think really what a lot of it comes down to is the sheer inventory. So Baltimore, Pennsylvania, Philadelphia, and South Jersey, all of those states, they have pretty significant supply constraints. So, right, if you look at the data, it's less than 50% inventory than they had pre-COVID. So we have not experienced the massive development boom that you've seen in like Florida or Arizona, which a lot of you guys were on the call are from there. Where you're seeing a lot of new home construction. You're seeing a lot of outside interest from players outside of your current market and all over the country coming in and developing. So in a lot of those markets, you're seeing 50% more inventory than there was pre-COVID. In the markets we're in, Maryland, Pennsylvania, New Jersey, it's typically 50% or actually more less inventory than pre-COVID. Rental market strong. It's as of September of this year, it's up 4.5%. And one thing that's extremely important right now and on everybody's minds is affordability. Baltimore was ranked as the most affordable place to live on the East Coast. So when you compare it to DC, Philadelphia, Boston, New York, it is an affordable city, which I think is important. And they have some positive numbers, from people moving within the city, and new people coming into the city, more so than ever before. And I think a lot of that has to do with affordability. Kind of speaking to Baltimore City's job growth and just sheer GDP strength. This was the most recent data from a GDP economic perspective. Their economy topped out at $50 billion in 2022. That's a 5.9 increase between 21 and 22. To give you an idea, the U.S. economy grew by 1.9%. So, very healthy economy in the Baltimore market, and that's for a number of reasons. A lot of it has to do with the ports and just the sheer location of it. It's very well located for a lot of different reasons, from an economic standpoint. So kind of to what you were just speaking of, one of the things about Baltimore is there's a massive opportunity in Baltimore. When I hear investors and I hear people speak negative about Baltimore, I get excited because I think there's still opportunity there. A lot of times when investors are very bullish on an area, they go and the pricing is just baked in. It's hard to get stuff at a good basis. It's hard to compete. You're competing with local investors, you're competing with national investors, regional investors. In a market like Baltimore, there's a ton of opportunity, and what we do is very, very scalable, very repeatable. So the city has come out with numbers. It's over 13,000 vacant homes in the city. Vast majority of that is privately owned, but a lot of it is also owned by the city as well. So there's opportunities on both sides of the spectrum to purchase those vacant homes and redevelop them. And over 20,000 lots in the city for new development as well. Some of those could be one-off. Some of those could be, little, townhome developments and things like that, like Ryan was talking about. So ton of opportunity to develop. And as we said, just massive demand and for these types of homes and for, new homes, quality housing. So,
Hey, Peter, just a reminder, we have 10 minutes left.
Okay. So I'll flip through some quick pictures here. We did some before. Just like to create a visualization so you have an idea of, what we're doing and that kind of thing. We'll skip the case studies for now. Just kind of properties that fit the buy box that we talked about before. I've been using the term essential housing a lot. You hear workforce housing, affordable housing, attainable housing, missing middle. They're all a little bit different, but somewhat the same. It's all kind of shades of the same rainbow at the end of the day. So I like to use the term essential housing because that's really what this is at the end of the day. People need an affordable place to live. And really what it breaks down to is we don't want to see our tenants paying any more than 30% of their gross income towards their housing cost. The recession, I can send Daniel, if I give you this thing, can you send this out? Or, and people want to reach out to me, I can send you this really great data on why, because this is an important part. I think it's really right now with recession talk just constantly looming and, where things are going to be after the election and things like that. Having workforce, affordable housing, essential housing represented in your portfolio now more than ever, I think is extremely important because of the way it tends to perform during recession, because it's got historic high demand right now. And at times like that, you tend to see the demand go up because there's even more people that fit that bill. And you can see that on that slide there. So as we've been talking about, I think it's a smart decision because of the supply and the demand. And the cherry on top, we talked about this before, just the impact of it. What we're doing really provides a positive impact, not only for our investors from a financial perspective, but for the people that we're dealing with, the tenants, the communities. Going in and renovating homes has a lot of benefits economically through housing and inequality, through health and education. So that's an important part as well. So there's my contact info. We can open the floor up to questions.
All right, question number one. I think I have two questions here currently, and then we'll just open up the mics. So
Great.
Question number one is from SS. What's the average time to market for the single family home slash TH slash apartments that you construct? Townhomes slash apartments.
It's a perfect question for Ron.
Sure. So from the time of acquisition, if we're talking about a full development project, it's going to be about 30 to 45 working days on a home. And the reason I say 30 to 45 days is we permit our projects. So, we are certainly at the mercy of inspectors and government and agencies, or local government agencies. It's usually not too bad. From the time we complete the project, it's rare if one of our homes is not rented within 14 days. Typically, it's more like 7 days, just because of the level of demand.
And just to stress there, Ron's talking about a redevelopment. So something we're buying that's an existing property that we're redeveloping. The time frame on a new home, like a new townhome construction, would obviously be a little longer than that.
So,
All right. William is asking, does buying through an auction result in needing warehouse space?
Yeah.
auction, we're buying our
No.
property auction houses, not materials. We do have warehouse space though, up at our home base here in Pennsylvania. So we do have a warehouse. But when we're referring to auctions, that's buying property, not materials.
Okay. And then one more question here from Prolette. She says, I know you're not trying to sell, but what's an example investment return look like?
Can we talk about that?
Go ahead. Yeah. Go ahead.
Yeah. Well, we have different funds. You know what I mean? So I would say go to the website, GSPREI. We have different funds depending on what you want. You know what I mean? So we have fixed rate returns where we pay the investors between a 10 to 12%, depending on the term and the amount they invest. And then we have a growth fund where it's more of a traditional, equity pref with an equity split on top of that. And returns are projected upwards of 20%. And, like we said before in the slides, we're looking to create 30-40% equity in every deal.
All right. And then Glenn is asking, how often do you have to evict people? And if evictions, how long are you seeing this take before you can begin the rehab?
Sure. So we do buy properties that will have legacy tenants. Sometimes they're paying, sometimes they're not. And even sometimes with our own tenants, anybody who tells you they're doing this at scale and they don't have to evict somebody is probably not being totally truthful. But part of dealing with that is setting it up from the beginning, like making sure you have your proper licenses, your registrations. And if you do that, it's really not a painful process. In Baltimore, you can have somebody out in 30 to 45 days. But it's very important that you set it up on the front end to make sure you have your ducks in a row so that when you do go to court and you go through the process, you have all the proper paperwork, licenses, on and on and on.
Okay, we have another question from SS. Are there more locations that you're looking to expand to since it's only 2 states? What is the criteria to select which states you want to invest in?
So right now we're in 3. We're in Maryland, Pennsylvania, and New Jersey. And again, we're watching different markets all the time. I mean, I could go through a list of markets that I like. Delaware, I like. But Delaware we don't see a lot in Delaware. There's a couple of markets in Alabama I like. There's a number of different places, but something I mentioned earlier, we're also restricted by the amount of capital we have access to. So, and right now there is tremendous demand in the areas surrounding us. And you always are going to feel a little bit more comfortable when you can look, feel, touch, because it's right in your backyard. Baltimore is an hour and 45-minute drive for us. Southern New Jersey, 45 minutes. Our crews can reach all these locations. It doesn't mean that we would not go outside of our markets. We certainly would. If the capital allowed us to, we definitely would.
I was going to ask you, what's it like if you were to go down to Alabama or some other distant state? How do you put together a construction crew and how do you vet that?
Sure.
Well, I'll preface this too, Ron. We're in over 40 states on the note side of our business as well. So we do have a lot of connections in those areas. And Ron, you could speak to that.
Yeah. So having been in construction for over a quarter of a century at this point, it's hard to to say that. It kind of feels strange, but to Peter's point, on the note side of the business, we bid HECM auctions, which are government-backed reverse mortgages, where somebody is deceased. They're unoccupied properties, and the majority of it is just touch-up work and sell. They're spread out through the entire country. So we have a lot of contractors in other markets that we can tap on or tap to do the work. Now, if we were going to go into a market to do this particular model, we would go down, we would research it for a period of time, boots on the ground. We would put together a team that would spend a great deal of time there, and we would constantly recycle people in and out of those markets. Our teams have traveled in the past to other locations to do projects. That's not a problem, but we're not going to touch a market unless we feel 100% confident we can have control over what we're doing. Because in my experience, that's where you lose a lot of control, is on the construction management side of things. That's where we'll get away from it. So we don't ever want to change that we're keeping the majority of that in-house. We always are going to utilize subcontractors, but we want to have control.
A quick request. Can you go back to the case study slides so we can see those? And then I'm going to do Domingo's question, and then I lost it here. Okay, so Domingo's question is, from a business standpoint, is Maryland more protective to tenants over landlords compared to other states?
Relatively speaking, no. I would tell you Philadelphia is one of the more protective ones. And again, that's why it's extremely important that you have your ducks in a row when you're developing and leasing properties. But Baltimore, no. Baltimore, we've actually found is pretty fair when it comes to landlords.
Okay. And then the other question, I realize that the person who had the question here has deleted it, but I'm going to ask it anyways. Do you have any funds that have tax advantages?
Yeah. Our growth fund has our growth fund has tax
question.
advantages. Well, the investors have an equity percentage of the portfolio, so depreciation, it will trickle down to the investor. In our income fund, the tax advantage would be it doesn't generate a UBIT in the IRA, so a lot of times funds will generate UBIT in IRA. So the way that that's structured, it doesn't generate UBIT. The fund it's outside of the IRA doesn't have any tax advantages, but our growth fund does. That's a regular, profit and equity sharing fund, and the investors own a percentage of it, and all of the tax advantages of ownership. And we do cost segregation. We look to maximize, depreciation and all that kind of stuff. And because we're constantly renovating properties and constantly bringing new properties into the portfolio, there's always depreciation that we can maximize.
All right. Could we have everybody here take themselves off mute and thank Peter and Ron for coming in and talking to us today?
Yeah, thanks, guys.
Thank you.
Thank you.
Thank you. Thank you.
Thanks a lot.
Thank you.
Good stuff. Thank
Cool.
you.
Thank you.
I like that.
And I hope everybody here has a great week. We will see you again Friday at noon, every Friday at noon, except for the one after Thanksgiving and 1 or 2 in December. But we'll be right here again, and have a great week.
Thanks, Daniel. Thank you, everybody.
Appreciate it.